Have you ever looked at something like financial trading and just been drawn in by the idea of big returns? There's definitely something alluring there, this promise of like getting wealthy fast. But what often gets missed, I think, in that whole chase for profit is what really
Yeah.
makes for success long term. It's not just about finding one amazing strategy. So today we're doing a deep dive into Forex trading, and we're focusing hard on, well, maybe the most critical piece for actually lasting in the game, risk management. Our whole mission here is to sort of unpack how you can shift trading from feeling like a total gamble into something more disciplined by really getting these strategies that, protect your capital and help you grow profits. And yeah, all the insights we're talking about, they come from this really comprehensive lecture focused purely on risk management and Forex. The core idea, and it's so fundamental, is this. It doesn't matter how brilliant your trading strategy seems on paper. If you don't have solid risk control, you could lose everything, your entire capital. It really is the absolute foundation, non-negotiable. Think about it like a seatbelt in your car.
Now, the seatbelt won't stop you having an accident, right? But if one happens, it's absolutely essential. It's there to protect you. We'll probably come back to that idea because it really nails the protective side of risk management. Okay, so we've established it's crucial. You just can't trade without it. But let's dig in a bit. Why? Why exactly is risk management so vital, especially in Forex? What is it about Forex that makes this so indispensable?
Yeah, you've really put your finger on it. The nature of Forex itself it demands this discipline. First off, you've got the sheer volatility. Prices can swing wildly and fast, driven by global news, political stuff, economic changes. Things can turn on a dime. Without a plan for those swings, well, your capital's just out there, exposed.
Very exposed.
Then there's leverage, high leverage. Forex lets you control much larger positions than your actual account balance.
Which sounds great for profits.
Exactly. That's the hook. It magnifies potential profits. But, and this is the crucial part, it magnifies potential losses just as much. A small move against you, if you're highly leveraged and haven't managed the risk, it can have a huge, disproportionate hit on your account. It's a real double-edged sword.
Makes sense.
And that links directly to the next point, preventing those catastrophic losses. I mean, one single trade that goes badly wrong if it's not managed, or even just a string of smaller losses that you didn't cap. It can genuinely wipe out weeks, maybe even months of hard-earned profits. Risk management is basically your firewall against that kind of disaster.
Your financial firewall. I like that.
And maybe just as importantly, it's about emotional control, having a clear, defined risk management plan. It acts as a vital buffer against panic decisions, or greed-driven ones.
Ah, the classic enemies, panic and greed.
They really are. They're common pitfalls for traders, pushing you into impulsive moves that, let's be honest, rarely end well. When you've got a plan you've committed to and you trust it, you're just less likely to cave when emotions run high and the market gets choppy.
Absolutely. It's like you're setting rules for your future self, knowing you might get emotional.
Okay, so we get the why. It's essential for survival, for emotional stability. But for me, this is where it gets really interesting, the how. How do we actually do this? What are the concrete tools, the techniques we need to master? Let's get practical.
Exactly. The application is everything. So the first big one, the real foundation stone, is defining your risk per trade. The golden rule, you'll hear it everywhere, is risking only 1% to maybe 2% of your total account capital on any single trade. Okay, 1 to 2%. Now, I know some people hear that and think, wow, that's tiny. You hear traders saying, how can I make real money quickly if I'm risking so little? What's the counter to that?
That is a really common reaction, but it kind of misses the main point, which is staying in the game, survival. Think about it. If you have, say, $1,000 account, risking 1% is just $10. Risking 2% is $20.
Right.
The real power of keeping that percentage small is that it means your capital can actually withstand a string of losses. You could lose 5, 6, even more trades in a row and still have most of your capital intact, ready for when the wins come.
So it gives you staying power.
Precisely. It's about longevity. You're ensuring you live to trade another day, another week, another year. It's not about getting rich on one trade.
Got it. So related to that 1-2% rule must be how much you actually trade, right? The position size.
Exactly. That's the next piece. Position sizing. This is all about figuring out the right lot size or volume for your trade based on that risk percentage you just decided on. And there's a formula. It's pretty straightforward. Position size, account risk, that's your 1-2% in dollar terms, divided by your stop loss in pips times the pip value.
Okay, let's walk through that.
Sure. So say you're risking $20 on that $1,000 account. And you figure out your stop loss needs to be 20 pips away based on the chart. And let's say the pip value is $1 for a standard lot in this example. Then your position size is $20 divided by 20 pips times $1 per pip, which is $20 divided by $20, so one standard lot.
Ah, okay. So it directly connects your dollar risk to the trade setup itself.
Perfectly. It ensures the amount you trade is always aligned with your predefined risk tolerance, preventing accidental overexposure.
Makes sense? What's next in the toolkit?
Next up, and this is non-negotiable, stop loss orders. Mandatory. You have to set a stop loss order for every single trade you enter.
Every single one.
Every single one. Never, and I really mean never, enter a trade without knowing exactly where you'll get out if it goes against you and putting that order in place. Think of it as that automatic airbag. It's set to deploy and limit the damage if things go wrong.
Okay, mandatory stop loss. But where do you put it? Is it just an arbitrary number below your entry? Or is there more strategy to it? You mentioned things like ATR before, average true range. How does something like that help you place a smart stop loss?
Good question. It's definitely not arbitrary. Placement is key. You base it on the market structure, things like clear support and resistance levels on your chart, or, as you mentioned, the ATR, the average true range. This indicator gives you a feel for how the market is typically moving. It's volatility.
Right.
So if the ATR is high, meaning the market's making bigger swings, you might need to place your stop loss a bit further away, just to avoid getting knocked out by normal market noise before your trade idea has a chance to work.
So it adapts to current conditions.
Exactly. It's about giving the trade room to breathe, but still defining your maximum acceptable loss based on technical analysis, not just a random guess.
Okay. Stop losses are the defense. What about the offense, taking profits?
Right. That brings us to take profit targets and the crucial concept of the risk-reward ratio. Just like your stop loss, you need to plan your profit exit point before you even click the buy or sell button. The risk-reward ratio, simply put, compares how much money you're risking, distance to your stop loss, versus how much potential profit you're targeting, distance to your take profit.
And what's a good ratio to aim for?
Generally, you want to look for trades offering at least a 1.2 or ideally a 1.3 ratio. So if you're risking, say, $20, your 1 unit of risk, you should be aiming to make at least $40, 2 units of reward, or $60, 3 units of reward, if the trade works out.
So just to be clear, 1.2, good. 1.3, even better. What about 1.1? Risking $20 to make $20.
1.1 is, okay, it's borderline acceptable sometimes, depending on the strategy's win rate, but it doesn't give you much edge.
And anything less, like risking $20 to make $10, a 2.1 ratio the wrong way.
Generally considered poor, you're risking more than you stand to gain. Mathematically, that makes it very hard to be profitable long-term unless you have an extraordinarily high win rate.
This is where it gets really powerful for me, this idea, this connection between risk-reward and win rate. You hear that even with a 50% win rate, if you maintain that 1.2 risk-reward, you can be profitable. It sounds almost too simple. But I guess many traders get caught up chasing wins, wanting to be right more often. Why is it hard to embrace this?
It is a huge mental hurdle. Because winning feels good, right? We're conditioned to want to be right. So many traders instinctively chase strategies that promise high accuracy winning 70%, 80% of the time. But this risk-reward principle flips that on its head. It shows that mathematically, you don't need to be right most of the time. If you're disciplined about only taking trades where your potential reward is at least twice your risk, you can literally be wrong half the time, like flipping a coin and still come out ahead.
It's quite liberating, actually.
It really is. It shifts the focus from predicting the future perfectly, which is impossible, to managing risk and playing the probabilities over the long run. It's about process over prediction.
Okay, process. What else helps with process?
The final key tool is keeping a trading journal. Hugely important, often overlooked.
What goes in it? Just wins and losses.
Much more than that. You should log the details. Entry price, exit price, stop loss level, position size, the resulting profit or loss, of course, but also critically, why you took the trade, what setup you saw, and maybe even how you were feeling emotionally during the trade. Were you anxious? Overconfident? Did you make any mistakes? Follow your plan. What lessons did you learn?
It sounds like a performance review for yourself.
That's a great way to put it. It's your personal feedback loop. It helps you spot patterns in your trading, good and bad. Identify biases. See where you deviate from your plan. It's essential for growth and refining your approach over time.
Okay, these tools make a lot of sense. Risk per trade, sizing, stops, targets, journaling. Sounds like a solid plan. But, even with the best plan, things go wrong. People stumble. I mean, that feeling after a loss, that urge to jump right back in and make it back. Revenge trading, right? It's powerful. What are some of those common mistakes people make, even when they know better? And how do we get smarter, especially when emotions are running hot?
Oh, revenge trading is a classic. It's so tempting. But it stems from letting emotion override the plan. That's a major pitfall. And you're right, knowing the rules isn't always enough. Execution under pressure is key. So, common mistakes. Well, number one, as we keep saying, trading without a stop loss. It's the cardinal sin. Just opens you up to unlimited risk on that trade.
Yeah, we've hammered that one home.
Good. Another is risking way more than that 1-2%. Maybe they get impatient or overconfident after a few wins. They ramp up the risk, and one bad trade hurts them way more than it should.
Leads to bigger emotional swings too, probably.
Absolutely. Which feeds into revenge trading. You take a bigger than planned loss, feel angry or frustrated, and immediately jump into another trade, usually a poorly analyzed one, just trying to recoup the loss quickly.
Trying to instantly erase the pain.
Exactly. But your risk plan is designed to handle losses. It expects them. Trying to shortcut that process almost always digs a deeper hole.
What else?
Using high leverage without fully understanding it. We talked about leverage amplifying losses. Some traders get seduced by the profit potential and don't respect the downside, ignoring major news events. Big announcements can inject massive volatility. Trading right through them without adjusting your plan or stepping aside can be dangerous.
Like trying to stand in front of a freight train.
Pretty much. And finally, just failing to stick to the plan they created. They do all the work up front, make a solid plan, and then the market moves a little, they feel fear or greed, and they just abandon it. Lack of discipline.
So discipline is key. Are there any sort of advanced tips or safeguards people can use to bolster that discipline?
Definitely. Beyond the core tools, you can add layers. One big one is avoid overtrading. Focus on quality setups, not quantity. You don't need to trade constantly. Sometimes the best action is to sit on your hand.
Patience.
Patience, yes. Another practical tip, use a risk calculator. Lots are available online or built into platforms. They automate the position sizing calculation, reducing the chance of error. Cultivating a calm, focused mindset is huge. Maybe through mindfulness or just taking breaks. Trading when you're stressed or tired is usually a bad idea.
Makes sense. Treat it like any high-performance activity.
Exactly. Also, maybe be extra cautious or just avoid trading entirely during those really high-impact news events, unless you're very experienced and have a specific strategy for it. Consider reducing your trade size during periods when the market just feels weird or unusually uncertain. Adapt your risk down if needed. And overall, constantly work on shifting your thinking from emotions to probabilities. Remind yourself, each trade is just one instance in a long series. Trust the process, let the probabilities work out.
Okay, so we've got the why, the how-to tools, the common mistakes, even some advanced tips. This is great theory. But could you maybe walk us through a concrete example? Show us how this actually plays out in practice. Like, how does that 50% win rate plus good risk management actually lead to profit? Let's see the numbers.
Absolutely. Let's make it real. Imagine you start with a $2,000 trading account. You're sticking to the 2% risk rule. So 2% of $2,000 is $40. That's your maximum risk per trade.
Okay, $40 risk per trade.
Now, let's say for a particular trade setup, you determine your stop loss needs to be 25 pips away from your entry point. And just for simplicity in this example, let's assume the pip value is $1 per pip for the position size we'll calculate.
Got it. $40 risk, 25 pip stop loss.
Right. Now we use our position sizing formula. Account risk divided by stop loss in pips, EPS, pip value. So that's $40 divided by 25 pips x $1 per pip, which is $40 divided by $25. That gives you a position size of 1.6 lots for this specific trade.
Okay, so the math dictates the size based on the risk and the stop.
Precisely. Now, let's bring in the risk-reward ratio. We're aiming for at least 1.2. So if you're risking $40, 1 unit of risk, your take-profit target should be placed to capture $80, 2 units of reward.
Makes sense. Risk $40 to make $80.
Exactly. Now let's simulate a sequence of 10 trades using these parameters. And let's assume you're not a market wizard, you just have a 50% win rate. So out of 10 trades, you win 5 times and you lose 5 times. Perfectly average.
5 winners, 5 losers. Break even on accuracy.
Right, so let's calculate the outcome. Your 5 winning trades each made $80. So 5 times $80 is $400 in profit.
Nice.
Your 5 losing trades each lost $40 because your stop loss was hit. So 5 times 40 is $200 in losses.
Oh, yeah.
So what's the net result? You made $400 and you lost $200. Your total profit is $400 minus $200, which equals $200.
Wow. So even being right only half the time, you still made a $200 profit on a $2,000 account over those 10 trades.
That's the power of it right there. This is the huge aha moment for many traders. It demonstrates so clearly that you don't need to be perfect. You don't need a crystal ball. What you need is discipline. Disciplined risk management consistently applied. That 1.2 risk reward combined with proper position sizing and stop losses creates a positive mathematical expectancy even if your predictive skill is only average.
That really drives the point home. It's the system, the process, not magic predictions.
Exactly. It's about playing the long game with a solid defense.
Okay, so wrapping things up then. If there's one core message, it really is that risk management is your shield. It's what protects you in the Forex battlefield. Without that shield, you're not really trading, are you? You're just gambling, hoping for the best.
That's a perfect summary. It's the difference between speculation and professional operation.
So let's just quickly bullet point those key takeaways again for everyone listening. First, only risk that small percentage, 1% to 2% of your capital on any single trade. Protect that capital. Second, use proper position sizing. Always. Calculate it based on your risk and stop loss.
Crucial linked.
Third, mandatory stop loss orders on every single trade. No excuses. It's your airbag.
Non-negotiable.
Fourth, aim for that positive risk-reward ratio, at least 1.2, maybe 1.3 if you can find it.
Gives you that edge.
Fifth, keep that detailed trading journal. It's your tool for learning and improving. Your flight recorder.
Essential for growth.
And finally, work on staying emotionally neutral. Calm. Focused. Let the plan and the probabilities guide you, not fear or greed.
Master your mindset.
So maybe a final thought to leave everyone with. Consider this quote. Don't focus on how much you can make. Focus on how much you can lose. Think about that for a second. It flips the usual script, doesn't it? It's a mindset focused on protection, on preservation first and foremost.
Capital preservation is rule number one.
And maybe think about how that mindset applies not just in trading, but anywhere in life where there's risk involved. True mastery maybe isn't just about chasing those big wins, but about carefully managing the downside, preserving what you have, and building steadily on a really solid foundation. Smart defense leading to sustainable offense.
Well said. That's the path to longevity.